My name is Daniel Ruiz. I'm the founder of Blinders Off Research. I focus on consulting and research products for the automotive sector.
What's the recent backstory on your auto sector analysis?
So I think it's important to start with a quick recap of what's happened. My original interview with Real Vision was in 2017. It was at a time when auto sales were slowing down significantly. GM had a very high day supply of vehicles that they were trying to work through. And things from a good short opportunity perspective looked very, very good. We had a bit of a surprise in August with hurricanes that both reduced the size of inventory of new vehicles, but also spurred replacement demand and kind of jump-started the auto sector a bit for a couple months. Shortly thereafter, I actually reached out to Real Vision again, and I said, this is a really, really good opportunity to re-engage a short position in several different names. And the reason why was primarily because of what was happening with the used car market. Dealers anticipated demand would increase substantially from folks looking to replace vehicles that were destroyed in the floods. So what they did is they speculated and they went to the wholesale auctions, and used vehicle prices increased substantially because of that. I saw a big problem with this because I didn't view it as healthy demand. Healthy demand is when you sell a vehicle, you go to the wholesale auction and you replace it to maintain proper inventory levels. This was speculation, and what it led to was a very, very large spike in used vehicle values in September. I should state that I look at used vehicle values as consumer purchasing power because so many of the new vehicle transactions involve a used car trade. So this was all very healthy for the auto industry in the short term, but it wasn't something that was going to last. And sure enough, a couple of months after stating these concerns with Real Vision again, in terms of an article that was written, used car values declined substantially. We did finish 2017 with lower sales than we did the prior year, which was an all-time high. And again, the short thesis was looking very strong through the first 2 months of 2018. I have long-term indicators that help investors gauge the climate, the demand picture going forward for a long period of time, but I also have shorter-term indicators that act as an early warning system if something is going wrong, or as an indicator that things are progressing the way that your short thesis envisioned.
What standard indicators are used to forecast vehicle sales?
So I'm going to discuss a few indicators that are very highly regarded in the auto industry, but also a few economic indicators that are heavily relied on in the industry when it comes to forecasting vehicle sales volume, and also are important to margin as well. And by that I mean how it specifically relates to publicly traded auto companies. In order for a company, as a general rule, to have their stock price increase, they need to increase revenue and earnings over time. And the way that you increase revenue and earnings is by increasing the volume of production when we're talking about companies like Ford, GM, FIAT, Chrysler. There's several indicators that both these companies and other folks that cover these auto stocks use to gauge future performance of production volume and also how margins might be impacted. So I'm going to start with industry-specific indicators that are often communicated to investors, to analysts, by manufacturers, publicly traded dealers, that help give some sort of future guidance into demand. And one that's heavily relied on, one that was actually used very recently by GM at an investor meeting, was the average age of vehicles that are registered. So the thought pattern here is, as the vehicle age increases, you can assume that there will be extra demand because the vehicles will need to be replaced at some point. The challenge with this, that I know personally from boots on the ground experience, is that folks that own very old vehicles, like I believe the average age right now is around 11 years, they don't tend to trade those vehicles on brand new vehicles. They trade those vehicles on pre-owned cars, on certified pre-owned cars, on 7 or 8 year old vehicles. They don't upgrade in steps that large. So if you look at the chart, you can see that starting from 1976 to current time, the average age of vehicles has just gradually increased. And that's because the vehicles are better built now than they were before, so they last longer. But the vehicle has multiple owners through its life cycle. So the vehicle can be remarketed several times throughout its life cycle before it's ultimately scrapped. It is not in any way, shape, or form a good indicator of demand for new vehicle sales for the reasons that I just stated. So the thing that I would caution investors on or analysts when looking at that data, that indicator itself, vehicle age, should not be used in my opinion because, again, folks that own older vehicles are more prone to buy used vehicles than they are new vehicles. The volatility that you see in new vehicle sales, there's no leading volatility in vehicle age that would make you assume that if, like for example, if the vehicle age all of a sudden dropped dramatically, future demand for new vehicle sales would fall. So we can't make that assumption based on that data, and we shouldn't.
What are scrappage rates?
Another industry indicator that's heavily relied on is the amount of vehicles that are scrapped. The reason why investors and analysts look at this indicator is because the assumption is the more vehicles that are scrapped, the more vehicles will need to be replaced. But again, going back to what we discussed, the vehicles that are being scrapped are older vehicles, and the folks that are scrapping those vehicles, of course they're going to replace them with another, but it's not necessarily going to be a new vehicle. They're buying pre-owned cars, certified pre-owned, 5, 6, 7-year-old cars. So again, it's not a good indicator for forward demand of new vehicles or vehicle production. As you can clearly see in the chart, there's very few instances of direct correlation between new vehicle sales and the amount of vehicles that are being scrapped.
How are economic indicators used to predict auto sales?
So I'm going to move on to heavily relying on economic indicators. This is important because in almost every communication from analysts, from manufacturers, you'll see something about the employment rate and how important that is to future demand. The challenge is that when we look at a chart of the unemployment rate in previous auto cycles, in almost every circumstance, the auto cycle has peaked ahead of unemployment rising. It's a lagging indicator, and there are things that are more crucial to new vehicle sales volume than just employment. It's obvious that you need a job in order to purchase a vehicle. It's obvious that you need income, but there are other things that slow down the velocity of new vehicle sales, which we're going to discuss in a moment. The other economic indicator that's very heavily relied on, specifically not so much to volume, but margin, something that's looked at for forecasting pricing power, is income. As you can see in the chart that I've provided, the average household income has always peaked after auto cycles as well, which again leads you to the conclusion that it's important, but it hasn't been a leading indicator in previous auto cycles, so we shouldn't rely on it. Unemployment and income matter a great deal when you're in the middle of a down cycle, because you can use it to gauge how severe that down cycle is going to be, but it's not a good predictor of a peak in an auto cycle.
What indicators have you developed to forecast sales?
So now I'm going to move on to what actually works. And I should preface this by saying that what led to these indicators that I'm going to share with you right now was really frustration as an analyst myself and as a consultant myself, because I couldn't find any correlation or a strong enough correlation to utilize any of the indicators that I just mentioned in a way that would help investors and in a way that would help forecast future volume and margin. I started thinking back to my 15 years in the automotive industry and what I experienced with consumers, and the obvious non-starters, as I mentioned before, are, if you're not employed, you're not going to get an auto loan. If your income isn't sufficient, you're not going to get the auto loan. If your credit is bad enough, you're not going to get an auto loan. And that's more specific to new vehicle sales because you can always find a home for somebody with bad credit as it relates to a vehicle if it's old enough and inexpensive enough to offset the higher interest rates. But it's very difficult on a new car sale. The biggest challenge that I always ran into was trade-ins and the level of equity that the consumer had in their vehicle. That was one of the strongest objections that I continuously encountered in the auto industry. So it led me to start digging into, is there any correlation historically to equity and consumer behavior? I should also state that this is extremely important because 87% of new vehicle sales in the US are financed. On average, those vehicles that are purchased new, that have debt attached to them, are traded within 3 years. So we know, based on the average loan term, the majority of folks that are coming back to trade their vehicles have an outstanding balance on their loans. And the relation with the used car value, their specific vehicle, and the principal balance that's owed on that car is what often determines whether they're going to purchase a new vehicle or not. What I've noticed is throughout those transactions, if there was equity in the trade, the likelihood that a consumer would move forward with a new purchase was very high. If there was negative equity on the trade, what most often happened is they would purchase a car, but just not right then and there. They would delay that new vehicle purchase simply because they were reluctant to raise their previous monthly payment. So what I wound up doing is I created my own indicator through my research, and this is the one that I find has the strongest correlation to new vehicle cycle highs and lows. I call it time to equity. And in essence, what I'm trying to do is I'm trying to gauge the health of a 3-year-old loan that was originally a new vehicle purchase. I do so by taking the average transaction price, the incentive data for that particular year, the average loan for that year, and the average interest rate. I then amortize that loan, and 3 years forward, I take the value of a 3-year-old car, and through a proprietary formula that I developed, I can identify the month in which that consumer or that group of consumers would reach the break-even point on their loan. So at the point where the used car value outweighed the principal balance owed. I then charted that data starting in the early 2000s to current day, and I found that my suspicions were correct as far as consumer behavior and equity go. The faster a consumer reaches the break-even point, the faster they're going to purchase a new vehicle, which increases new vehicle sales velocity. The longer it takes them to reach equity, the longer it's going to take for them to purchase a new vehicle, which decreases new vehicle sales velocity. And you can see in the chart that I provided that time to equity peaked in 2008, and that was at 36 months, I believe, and the new vehicle sales bottomed in 2009. Folks don't stop buying cars, they just delay it until it's a better proposition. And I should state that there were other things that made the last down cycle in autos as severe as it was, but the time to equity indicator is I think one of the best indicators moving forward to gauge consumer demand. And the reason why is because it's telling us how long it's taking them to get to equity on their loans. And the surprise in 2018 was used car values increased dramatically, which offset the longer loans and higher interest rates. So 2018 would be folks that purchased in 2015. Used car values increased so much that it actually offset the higher loan, the longer loan terms that they took and the higher interest rates that they paid during that time period. Interestingly enough, when I take the abnormal used car appreciation that we had in 2018 and I plug it into the grouping for 2019 as it relates to time to equity, you can see that time to equity spikes up to 33 months. And that's just solely from the extended loan length that buyers took from 2015 to 2016 and the increase in interest rates. The important takeaway from that is I don't expect used vehicle values to remain as elevated as they did in 2018. That's something that was extremely rare. Every one residual point drop will increase time to equity by 1 month. So if we have a fall of residuals by as little as 3%, which is really not a lot, we're going to be right back to the 2008 high in terms of time to equity, which is going to put serious pressure on new vehicle sales. The other reason why used car values are so important is because they determine where captive banks are going to set residuals. As you can see in the chart that I provided, if used car values fall, residuals are going to fall, which in turn increases monthly payments and will have a negative impact on new vehicle sales. There's a very, very tight correlation between lease originations and new vehicle sales. Looking forward into where we are right now, just ahead of Q4 earnings. I've provided 3 charts that are wholesale estimates. This is a product that I offer to kind of give investors a early warning on what their expectations are, whether they're long or short, so they can plug the information into their financial models in a way that's more accurate than just using a SAR number.
What's your view on Ford?
And as you can see for Ford, the wholesales are just slightly under last year, but importantly, I've broken up the car, truck, and SUV mix, and the mix is much better. So we can assume that volume is going to be the same in the US, but the mix of trucks and SUVs are much higher, so that's going to equate to higher margins when they report. Ford is actually a company that I think is a good opportunity at this point to accumulate shares in. I don't think that the down cycle is over. I think that we're just getting started, but it's a company that's heavily discounted. It's a company that over the years has done the right things, in my opinion, in terms of lowering contracted residuals, managing inventory. They have a new truck that's coming out, which should be a very, very big positive for volume and margin because it's not replacing a vehicle, which is important. It's not a net difference to the bottom line. It's going to be a straight add in terms of the new Ranger. I like what they're doing with autonomous technology. They're focusing on commercial use rather than personal use, which I think will have a much higher adoption rate.
What's your view on GM and FIAT?
Although we're going into Q4 with GM being somewhat flat in volume, and I would assume a little bit better mix as well because they just recently put out their new Silverado. Going forward, I think GM and FIAT are both good short positions. And this is a big contrarian because most investors, especially value investors, look at those stocks and they see the low PEs, they see the margins, they see that new vehicle sales haven't dropped off as much as some folks anticipated, and so they think they're good purchases. But I disagree. Again, time to equity tells me that volume is going to drop off. Inventories will likely increase, which puts pressure on margin when manufacturers have to increase incentives to sell the new vehicles. And I think that both revenue and earnings are going to be pressured going forward for both GM and FIAT. FCA is probably the toughest one to call, and it's the one that I think investors are most in danger of if they're on the long side. And the reason why is because, again, from a value investor standpoint, their balance sheet looks terrific. Their sales were up 8.5% this year. But something that's important to note here is that, again, going forward, I think that sales volumes are going to be pressured for the reasons I mentioned. But also, the thing that they did, which was very dangerous and kind of surprising, is they actually overproduced significantly. And in October, they had a 100-day supply of new vehicles. It's dropped down to 89 days in December, but that has a lot to do with seasonality. I say that because they factored day supply when it comes to just the prior month's sales. So to give you a quick example of what I mean by that is, if they have the same amount of inventory in January and their sales increase by 10%, they're going to have a 115-day supply of vehicles. And day supply should be looked at by investors as margin of safety when it comes to production. And again, that's where the earnings for these companies come from. It comes from increasing production and increasing margins. So the production at FCA, in my opinion, is in danger going into 2019. I think they're going to have a very, very difficult time exceeding comps, both volume and mix. Mix is still very much an argument for the bulls, but I'd like to point to a chart that I've provided which shows that mix was skewed to a dramatic point in 2018, where at the highest point, I believe in August, we reached a light truck market share of 71% to 29% cars. So expecting a higher mix of vehicles going into 2019 to offset any volume declines, I don't think is a good strategy from an investing standpoint.
What's the short case for HERTZ?
The other one that I think is a good short opportunity is HERTZ. And I say that because, again, in 2018, we had abnormal used car appreciation. And in Q2 and Q3, the earnings were very encouraging after Hertz's performance in the prior year, year and a half. But investors need to know that from a business standpoint, as used car values rise, their depreciation expense falls. Hertz is a company that is in a very, very difficult position from a revenue per unit standpoint, in my opinion, because of competition. You have Lyft and Uber that are servicing the consumer on a short-term basis. On a longer-term basis, you have competition such as Turo, which is gaining share in the industry, and then also Maven from GM. And then on an even longer term than that, something that's starting to gain traction are used car subscription services. So you're dealing with a company that has tremendous downward pressure on revenue from competition and increasing expense in terms of depreciation. And I think they're going to have a very, very tough go going into the future. And I think it's a good long-term short. On the long side, again, I mentioned Ford. I think that Ford is a good company, something that could be bought now, accumulate shares, take advantage of the high yields and the valuation, because they will exit this down cycle in autos ahead of the others, in my opinion. But another interesting one too is Carvana.
What's your view on Carvana?
Carvana is an online-only retailer, and investors look at that company and they say, okay, they're not profitable right now. So you question the stock price, the valuation, but we really need to look at it from a growth standpoint. Carvana has a significant advantage over its competitors in terms of scaling. To give you a quick example, a traditional dealer the average cost of a new dealership, including inventory, is about $11 million. For Carvana to enter a market, the average cost is $500,000. So from a scaling perspective, they have a significant cost advantage over their competitors. And truly, I just think that's one of the trends that should really, really be followed in this industry, ahead of autonomous driving, even ahead of electrification, because I think that there's further technology advances that need to happen in that area in order to have electric cars scale. Online is something that the consumer is ready for. It's something that they've been conditioned for by companies like Amazon. They're used to buying items without having to feel them and touch them. Used car prices the trend is going to one price, so there's less friction in that respect from clients. And Carvana takes care of the fear of purchasing a bad car away by offering a 7-day return policy.
In conclusion, what should investors focus on?
So to finish, the main reason why I wanted to do this today was because I want investors to focus on the true drivers of the auto industry, and not to be given a false assurance by indicators, again, that have very little correlation to new vehicle sales, whether they be economic or industry specific. There are things that drive the auto industry from the ground up, one transaction at a time, that really matter, and those are the things that we need to be focused on. And when it comes to those things, there's serious deterioration happening, a lot of which was masked by used car performance in 2018, that I personally think wouldn't be prudent for somebody that's analyzing the auto sector to plug that into a financial model, or any model that forecasts future sales shouldn't have used car appreciation built into it. I think that used car values are going to decline. 2019 is the peak in lease maturities. I think we're running into issues with new vehicle pricing, which is evident in loan terms that are increasing and in very aggressive. If new car pricing unwinds, if we have that's going to pressure used car values. If used car values are pressured, return rates are going to increase, which means that there's going to be increased supply at wholesale auctions, which is going to pressure used vehicle values. And as used vehicle values fall, time to equity increases and residual values fall. I don't think we're in an environment of growth. I think we're in an environment where we're going to decline in the fundamental factors that I believe are extremely important, the ones that fuel growth, the ones that fuel margin. And I just want to make investors aware of the situation that we're currently in.